If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge, and when we help others grow, we grow too. Thank you so much for listening. Let's dive into the book. Chapter 1, The Art of Risk and Reward. Part 1, The First Step. What is risk, really? Imagine standing at the edge of a forest. You need to cross it before nightfall. For one person, this is an exciting adventure. For another, it's paralyzing fear. The forest hasn't changed, only what each person brings to the journey. This is risk. Not a spreadsheet calculation, but a living thing shaped by who you are, where you've been, and where you're trying to go. Risk in investing often gets reduced to volatility percentages or loss probabilities. But Benjamin Graham, the father of value investing, saw it differently. For him, risk wasn't just market fluctuations, it was the permanent loss of capital when reality diverges from your assumptions. Consider long-term capital management in 1998. Nobel laureates built complex models predicting bond movements with 99% confidence. They treated risk as pure math, forgetting that markets reflect human behavior: panic, greed, herd mentality. When Russia defaulted on debt, an event their models gave near zero probability, their $4.6 billion fund imploded in weeks. The math was right until real people made unexpected choices. Your personal circumstances transform risk's meaning. A retiree living off savings experiences stock dips differently than a 30-year-old building wealth. Morgan Housel illustrates this in The Psychology of Money. Two investors might hold identical portfolios, but if one has stable income and the other relies on investment returns, their actual risk exposure differs radically. Emotions amplify this divergence. Behavioral studies show losses hurt twice as much psychologically as equivalent gains please us, a phenomenon called loss aversion. That's why during the 2008 crash, some sold everything at market lows, locking in losses, while others with identical portfolios held firm, guided by different life experiences. Risk's core is uncertainty, not just financial loss, but the gap between what we plan and what occurs. Seth Klarman's margin of safety emphasizes this. True safety comes from preparing for multiple futures, not predicting one. Think of it like packing for unknown weather. If you only bring a raincoat, a heat wave becomes catastrophic. But if you pack layers, you adapt. Graham's margin of safety principle works similarly. Buying assets so cheaply that even if your thesis is partly wrong, you still avoid permanent loss. Consider how personal goals reshape risk. Investing $10,000 for a house down payment next year carries different stakes than investing for retirement in 2040. In one documented study, investors shown their portfolio as college savings for your daughter took 30% less risk than those told it was retirement funds. Same money, different emotional weight. Risk isn't inherently good or bad. It's the cost of opportunity. No farmer plants seeds without risking crop failure. No entrepreneur starts a business without risking bankruptcy. The question isn't how to avoid risk, but how to align it with your unique path through the forest. What looks like a storm to one traveler might be cleansing rain to another. Next, we'll see how chance and uncertainty, those unpredictable winds, shape every investment journey. Part 2. Meeting uncertainty. Luck, chance, and the unexpected. Consider the fall of long-term capital management. In 1998, this hedge fund managed by Nobel laureates and Wall Street elites collapsed spectacularly. Their sophisticated models accounted for thousands of market variables, yet they failed to predict Russia's sudden debt default. Within months, $4.6 billion vanished. Their mistake wasn't poor research, but believing they'd eliminated uncertainty. As Nassim Taleb observed, we consistently underestimate how randomness shapes outcomes. True investing mastery lies in separating skill from luck. Take Warren Buffett's 1964 investment in American Express during the salad oil scandal. When fake inventory tanks crushed its stock, Buffett analyzed the brand's enduring customer loyalty, a skillful assessment of recoverable value. Yet he admits timing his entry during the panic involved fortuitous circumstance. Skill identifies opportunity, luck influences timing. Studies of mutual fund managers confirm this. Research from Berkeley shows less than 5% consistently outperform due to skill alone over decades. Most apparent genius streaks fit statistical probability, like flipping heads 10 times consecutively. So how do we prepare? Benjamin Graham's margin of safety principle offers guidance. By purchasing assets far below intrinsic value, say, a stock trading at 60% of its calculated worth, you build buffers against unforeseen events. Klarman applies this by holding cash reserves during market euphoria, allowing him to pounce during crashes like 2008. Diversification achieves similar protection. Had LTCM spread bets beyond sovereign debt, one geopolitical shock wouldn't have doomed them. Psychological readiness matters equally. Morgan Housel notes that accepting unpredictability reduces panic-driven decisions. When COVID-19 crashed markets in 2020, investors who'd mentally prepared for volatility held steady. Many even bought undervalued stocks, a move that delivered triple-digit returns by 2021. They didn't predict a pandemic. They'd built systems for any storm. Uncertainty isn't a flaw in investing. It's the landscape. The wisest investors treat it like ocean currents. You don't command them, but you learn to sail through them. Next, we'll examine how rare, earth-shaking events test these principles. Part 3. Stories from the edge, black swans and big surprises. Remember LTCM's collapse? That was just a tremor. History shows markets get hit by true financial earthquakes, events so rare and powerful they shatter all predictions. Nassim Taleb called them black swans, occurrences deemed impossible until they happen, reshaping everything in their path. Consider the 1918 influenza pandemic. Economists then believed modern medicine and global trade networks made widespread economic paralysis unthinkable. Yet the virus killed millions, collapsing supply chains and markets. Fast forward to September 11, 2001. Pre-attack risk models for airlines or insurers never factored in coordinated hijackings. Markets froze. Then came 2008. Complex mortgage derivatives rated safe by experts ignited a global crisis. Each event shared 3 traits. It was unimaginable beforehand, carried massive consequences, and seemed predictable in hindsight. Why do we keep missing these? Our brains are wired for linear thinking. We extrapolate from recent history, assuming tomorrow mirrors yesterday. Ben Graham knew this flaw well. He wrote that investors often mistake a temporary boom for permanent growth. The dot-com bubble proved him right. Psychologists call this the normalcy bias, our tendency to underestimate disaster likelihood because it feels too distant or abstract. But here's the counterintuitive truth. Black swans aren't always destructive. They create fortunes too. When COVID-19 struck, Netflix added 37 million subscribers in 6 months. Zoom's revenue tripled. Neither company predicted a pandemic, but their scalable models turned chaos into opportunity. Similarly, Bitcoin was dismissed as a fringe experiment until the 2013 Cypriot banking crisis revealed its value for bypassing failed institutions. Its price soared 90x in 4 years. How do you prepare for the unimaginable? Seth Klarman's approach is instructive. His margin of safety principle, buying assets far below intrinsic value, creates buffers no model can quantify. When the 2008 crash hit, he had dry powder to acquire distressed debt at 30 cents on the dollar. Others panicked, he profited. Morgan Housel adds another layer. Save like a pessimist, invest like an optimist. Hold cash reserves for survival during crashes, while staying invested for unexpected growth. The Japanese yen offers a sobering lesson. For decades, it was seen as a safe haven currency. Then the 2011 Tohoku earthquake triggered a nuclear meltdown. The yen plunged 7% in hours as factories shut and radiation spread. Investors learned no asset is inherently black swan proof. Resilience lies in accepting limits. As Taleb argues, don't predict the hurricane, build a sturdy boat. This means diversifying beyond stocks and bonds, into real assets like farmland or gold that thrive during inflation shocks. It means stress testing portfolios. What if another 9/11 halts air travel? Or what if AI makes 40% of jobs vanish overnight? Most crucially, it means defining your personal ruin threshold. How much loss could you absorb without life-altering damage? That line is your North Star. Next, we'll explore how to weave these buffers into your strategy, not as armor against fear, but as fuel for calculated courage. Part 4. The Safety Net. Protecting yourself from the unknown. Imagine standing at the edge of a cliff, harness secured to steel anchors. That harness transforms terror into possibility. It's the difference between paralysis and climbing higher than you ever thought possible. Investing works the same way. Safety nets aren't about timidity. They're what let you swing for the fences. Benjamin Graham, the father of value investing, taught this through his margin of safety principle. He bought stocks trading far below their intrinsic value, like purchasing a dollar bill for 50 cents. This buffer absorbed errors when his analysis missed hidden risks. During the 1973-74 crash, investors using this approach, like Warren Buffett, saw temporary paper losses but avoided permanent ruin. Their safety net allowed patience while others panicked. Diversification serves a similar purpose. Consider the 2000 dot-com crash. Investors holding only tech stocks faced devastating losses. Those with broader portfolios, including bonds, international stocks, or real estate, absorbed the blow. Apple survived the crash because Steve Jobs diversified into music players, iPods, creating revenue streams beyond computers. This wasn't just asset allocation, it was structural resilience. Stop-loss orders act as circuit breakers. In 2010, the flash crash wiped $1 trillion from markets in minutes. Traders with automatic sell triggers at 8% losses preserved capital. Those without watched gains vanish in seconds. Van Tharp's research shows position sizing, never risking more than 1–2% of capital on a single bet, prevents any one failure from crippling you. Psychologically, these tools quiet the amygdala's scream. Neuroscientists find that knowing your ruin threshold, as Taleb calls it, reduces cortisol spikes during volatility. Klarman's clients at Baupost Group take bold positions in distressed assets precisely because 30% of their portfolio sits in cash, ready to pounce when others flee. The LTCM collapse in 1998 proves what happens without nets. Nobel laureates used complex models but ignored black swans. When Russia defaulted, their over-leveraged bets imploded. A 4% portfolio drop became a 100% catastrophe. Contrast this with Ray Dalio's all-weather strategy. By balancing assets that thrive in different conditions, gold in inflation, bonds in deflation, his fund weathered 2008 with single-digit losses while markets fell 38%. Your safety net isn't a cage. It's the trapeze artist's confidence to release the bar midair, knowing the catch is engineered. Define your personal thresholds. How much can you lose without life-altering damage? Then build accordingly. That clarity turns risk from a threat into an invitation. Next, we'll examine how to spot when the net itself becomes a trap, when excessive caution strangles growth. Chapter 2. Lessons from the Legends. Part 1. The Value Mindset, Why Patience Pays. Consider the story of Walter Schloss, a student of Benjamin Graham who outperformed the market for 5 decades. With no fancy office or computer, he followed one principle: buy stocks trading below their net current asset value, then wait. His 16% annual returns weren't magic, they were mathematics meeting patience. Value investing isn't about predicting next quarter's earnings. It's recognizing that markets behave like moody auctioneers, sometimes pricing treasures as junk. Benjamin Graham demonstrated this during the Great Depression by buying companies selling below their cash value, essentially paying 50 cents for a dollar bill. His discipline turned market panic into opportunity. Warren Buffett transformed this philosophy into an art form. When American Express collapsed during the 1963 salad oil scandal, others fled. Buffett calculated the company's fundamental earning power remained intact. His $20 million investment grew to over $1.5 billion because he saw beyond the headlines. The stock market is designed to transfer money from the active to the patient, he'd later observe. Modern temptations test this resolve. During the 1999 dot-com frenzy, value investors like Seth Klarman underperformed as speculative stocks soared. Klarman's Baupost Group returned just 0.8% that year, while the Nasdaq jumped 85%. Yet when the bubble burst, his cash reserves allowed him to acquire distressed assets at fire sale prices. Those who chased hype lost shirts. Those who waited gained mansions. Psychology plays a crucial role. Studies show investors who check portfolios daily experience 30% more stress than quarterly reviewers. The 1987 market crash saw the S&P 500 drop 20% in one day, yet recovered fully within 2 years. Those who sold locked in losses. Those who ignored the noise preserved capital. This mindset extends beyond stocks. Real estate investor Sam Zell famously quipped, "When everyone's going left, look right." During the 2008 crisis, he acquired distressed properties others abandoned. By 2012, his equity had tripled. The common thread? Treating investments like crops, planting in fertile soil, then allowing seasons to pass before harvest. What separates winners isn't brilliance, but endurance. The Dow Jones took 25 years to recover from the 1929 crash, yet investors who reinvested dividends and held broke even in 15 years. Impatience turns temporary declines into permanent losses. Discipline converts volatility into compounding fuel. True value emerges when others panic. As Graham noted, in the short run, the market is a voting machine. In the long run, it's a weighing machine. Your next advantage? Letting time measure what others misprice. Next section naturally transitions into margin of safety. Part 2. Margin of safety. Building your own cushion. Imagine patiently waiting for quality investments only to watch their prices plummet after you buy. That's where the concept of a safety net comes in. It's your essential shield against the unpredictable. Benjamin Graham, the father of value investing, defined it simply: buying an asset for significantly less than your calculated estimate of its true worth. This gap isn't just a discount. It's your critical buffer against mistakes and misfortune. Think of it like building a bridge designed to hold 10 tons. You wouldn't drive a 10-ton truck across it on opening day. You'd want a structure capable of handling 15 or 20 tons, a reserve capacity for unseen flaws or unexpected stress. Similarly, a substantial price discount provides resilience. If your estimate of a company's value is slightly optimistic, or if the market turns sour for longer than expected, that discount absorbs the blow. It transforms a potentially permanent loss into a temporary paper loss, giving you time to be proven right. Warren Buffett's purchase of Coca-Cola stock in 1988 illustrates this powerfully. He bought when the company faced challenges, paying a price he believed was far below its enduring brand value and cash-generating power. Even if his analysis overestimated Coke's potential by 30%, the initial discount meant he was still likely protected. History shows the discount wasn't needed immediately, but it was there, silently working. This principle isn't just for stocks. During the 2008 financial crisis, investors who purchased high-quality corporate bonds at distressed prices, deeply below par value, often saw strong recoveries as panic subsided. The discount provided a cushion against further declines and amplified gains when normalcy returned. Conversely, the collapse of long-term capital managed serves as a stark warning. Their complex trades offered minimal safety margins. When unexpected global events hit, Russia defaulting on debt, tiny market moves against their positions triggered catastrophic losses because there was no buffer. Their genius couldn't overcome the lack of this fundamental protection. Building your own safety net involves disciplined calculation and restraint. First, estimate intrinsic value conservatively. Use pessimistic assumptions about growth and discount rates. Then, demand a significant discount to that conservative figure. 30% or more isn't unusual for seasoned practitioners. This often means buying when others are fearful, or when an asset is temporarily out of favor for non-fundamental reasons. Look for strong balance sheets, consistent cash flows, and durable competitive advantages. These qualities make intrinsic value estimates more reliable. Finally, acknowledge that you will be wrong sometimes. A robust safety net across your portfolio, achieved through diversification and strict price discipline, ensures no single error sinks your ship. It's the practical application of patience, transforming calculated weighting into tangible protection, and turning market turmoil from a threat into your strategic advantage. How much buffer do you demand before committing capital? Part 3. When genius fails, learning from mistakes that cushion you build? It's not just for obvious threats. Even the sharpest minds can misjudge risks when they forget its purpose. Consider the story of long-term capital management. Founded by Wall Street legend John Meriwether, with Nobel laureates Myron Scholes and Robert Merton on board, this hedge fund appeared unstoppable. They developed complex models to exploit tiny market inefficiencies, amplified by staggering leverage, sometimes borrowing $30 for every $1 of capital. Their intellectual firepower convinced them they'd quantified risk down to the decimal. Then came August 1998. Russia defaulted on its debt, triggering a global financial panic that defied LTCM's historical models. Markets moved in ways their equations deemed nearly impossible. Positions that were supposed to balance each other collapsed in unison. Within weeks, they hemorrhaged $4.6 billion. The Federal Reserve orchestrated a bailout to prevent systemic collapse. What happened? They mistook mathematical elegance for invincibility. Their models assumed markets would behave normally, ignoring how fear spreads during crises. Leverage became a trapdoor, not a ladder. This pattern repeats. Nick Leeson, a young trader at Barings Bank, hid escalating losses through unauthorized bets on Japanese derivatives. His initial small errors snowballed because no one questioned the star performer. By 1995, he'd destroyed the 233-year-old bank. In both cases, brilliance blinded them to simple truths. Models can't capture human panic, and leverage magnifies errors faster than gains. The lesson? Expertise without humility is brittle. LTCM's team knew more about option pricing than almost anyone alive, yet they overlooked correlation risk, how unrelated assets can crash together in a panic. Leeson understood Singapore's markets, but ignored the weight of mounting losses. True resilience comes from planning for your models to be wrong. That's why Warren Buffett keeps cash reserves even during booms, and why Ray Dalio builds portfolios to withstand 100-year floods. Failure teaches what success obscures. Adaptability beats complexity. After LTCM's collapse, surviving firms reduced leverage and stress-tested against extreme scenarios. Bridgewater Associates now flags decisions where overconfidence might creep in, a practice born from studying others' stumbles. Setbacks, when dissected without ego, build deeper wisdom than any algorithm. Next, we'll explore why these mistakes feel inevitable in hindsight, and how our minds trick us into repeating them. Part 4. The Psychology of Winning and Losing. Consider this. After the collapse of long-term capital management, psychologists interviewed surviving traders and found something startling. Even professionals who mathematically understood risk admitted to ignoring warning signs because winning felt too good to stop. Our brains aren't wired for rational investing. They're wired for survival, which makes loss avoidance overpower logic. This biological wiring explains why ordinary investors repeat history's costly patterns. Take loss aversion, demonstrated in Daniel Kahneman's experiments. People would rather avoid losing $100 than gain $150, a 1.5x incentive imbalance. During the 2008 crash, Vanguard reported clients who sold equities between October 2007 and March 2009 locked in losses averaging 30%, while those who held saw full recovery within 5 years. Fear physically overrides patience. Greed operates similarly. In 1999, Cisco Systems traded at 200 times earnings because investors ignored valuation fundamentals, chasing the dot-com dream. When it fell 90%, many doubled down near the bottom, not due to analysis, but because cheap prices triggered confirmation bias. We seek data supporting our hopes, dismissing warnings. Overconfidence compounds these traps. A Fidelity study revealed investors who traded most frequently underperformed the market by 6.5% annually. Why? Each win reinforced belief in personal skill, masking luck. This mirrors day traders during the 2021 meme stock frenzy. 80% lost money despite initial surges per FINRA data. Managing this requires structural guardrails. 1. The 24-hour rule. Ray Dalio's Bridgewater mandates a cooling-off period before acting on emotional market news. 2. Preset thresholds. Like Ben Graham's margin of safety buys, automate sell rules. If an asset drops 20%, exit first. Ask questions later. 3. Diversify timeframes. Allocate 90% of portfolios to long-term holdings, allowing 10% for speculative urges. This contains emotional damage. Charlie Munger once noted, "It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent." Winning starts by accepting that your brain will betray you and building defenses before the storm hits. Next, we'll see how combining this self-awareness with patience creates uncommon resilience. Chapter 3. Building Your Investment Adventure Part 1. Finding Your Path. What kind of investor are you? Here's how to discover your investment identity, a process Warren Buffett describes as knowing what you don't know. Start by asking 2 questions. First, how did you react when markets plunged 30% in March 2020? Did you sell everything, hold firm, or see bargains? Second, what's your purpose? Retiring comfortably in 20 years or chasing rapid gains? Your answers reveal more than any questionnaire. Consider real contrasts. Benjamin Graham, Buffett's mentor, exemplified the cautious builder. He sought undervalued companies with strong fundamentals, treating stocks like ownership stakes in businesses. His margin of safety principle, buying at prices far below intrinsic value, acted as armor against mistakes. At the other extreme, Jesse Livermore, the famed 1920s speculator, thrived on volatility. His autobiography recounts betting aggressively on price swings, winning and losing fortunes. Both approaches worked for their temperaments but would fail catastrophically if swapped. Try this exercise. List 3 investments you admire, perhaps a slow-growth index fund, a rental property, or Bitcoin. Now, beside each, write why it appeals to you. Is it stability? Growth potential? Excitement? Patterns emerge. Someone drawn to municipal bonds might sleep poorly owning volatile biotech stocks, no matter the potential returns. Each style carries trade-offs. Cautious investors like Graham often miss explosive growth. Few value investors owned Amazon in 2010. Adventurous traders may capture 10x returns, but expose themselves to wipeouts, as seen in the 2022 crypto crash where Lunacoin investors lost 99% in days. Seth Klarman's margin of safety argues that understanding these trade-offs is non-negotiable. Investing without self-awareness is like driving blindfolded. Finally, align your strategy with life goals. A 25-year-old saving for retirement might embrace stock market volatility, using dollar-cost averaging, as we'll discuss next. A 55-year-old nearing retirement may prioritize capital preservation through bonds or dividend stocks. Morgan Housel's research in the psychology of money shows that financial success stems less from intelligence than from matching strategy to personal circumstances. What's one investment that would keep you awake at night? If the answer is anything risky, your path leans conservative, and that's wisdom, not weakness. Your portfolio should fit like tailored clothing, not borrowed armor. Part 2. Tools for the journey. Simple strategies that work. Consider this. The most successful investors often win by doing less, not more. Take Warren Buffett, who once advised his wife to put 90% of his inheritance into a low-cost S&P 500 index fund and 10% in bonds. This wasn't complex advice from the Oracle of Omaha. It was a blueprint for harnessing 3 fundamental tools that withstand market chaos: dollar-cost averaging, asset allocation, and rebalancing. Dollar-cost averaging, DCA, turns market volatility into an ally. Instead of timing unpredictable swings, you invest fixed amounts regularly, say $500 monthly, regardless of price. When stocks dip, your money buys more shares. When they surge, you buy fewer. This discipline eliminates emotional decisions. During the 2008 crash, investors who maintained DCA in Vanguard's total stock market index saw their portfolios recover losses 18 months faster than those who paused contributions, according to Vanguard research. Like planting seeds in every season, you ensure some take root when conditions improve. Asset allocation matters more than stock picking. Benjamin Graham in The Intelligent Investor stressed holding both stocks and bonds to cushion against downturns. A 60-40 split, stocks-bonds, exemplifies this. Between 2000 to 2020, this blend delivered 6.5% annual returns with half the volatility of pure stocks, per JP Morgan data. Why? Bonds often rise when stocks fall, balancing your portfolio. Your allocation should mirror your risk tolerance. A 30-year-old might choose 90-10 for growth, while someone near retirement might shift to 40-60 for stability. Rebalancing enforces buy low, sell high without guesswork. Markets shift. If stocks surge from 60 to 70% of your portfolio, you sell some stocks and buy bonds to return to your target ratio. The Norwegian Sovereign Wealth Fund, managing $1.4 trillion, rebalances annually. This forced them to sell tech stocks near 2021 peaks and buy undervalued assets, adding $43 billion in value over 3 years. For individuals, rebalancing once or twice a year prevents overexposure to hot trends. These strategies share a psychological superpower. They automate rationality. Morgan Housel notes in The Psychology of Money that consistency is the investor's antidote to fear. DCA keeps you investing through panic. Allocation diversifies your bets. Rebalancing curbs greed. Together they build resilience against what Nassim Taleb calls black swan events, unpredictable crises like 2020's pandemic crash. Start small. Automate $100 monthly into an index fund for DCA. Use free tools like Morningstar's X-Ray to check your allocation. Set calendar reminders to rebalance. Complexity isn't sophistication, it's clutter. As Seth Klarman writes in Margin of Safety, the simplest path is often the most profound. Master these tools, and you'll have a compass for any market, freeing you to explore higher risk opportunities from a position of strength. Part 3. High risk, high reward. When to take the leap. Now that you've built a solid foundation with time-tested tools, let's address the elephant in every investor's room, the siren call of high-risk, high-reward opportunities. Think back to 2010, when a software engineer paid 10,000 bitcoins for 2 pizzas, worth $600 million at Bitcoin's peak. Or consider Blockbuster laughing off Netflix's $50 million acquisition offer in 2000, a decision that vaporized their business within a decade. These aren't just stories, they're psychological traps. Our brains are wired to remember the lottery winners, not the thousands who lost their shirts. Morgan Housel nailed it in The Psychology of Money. We judge risks by how visible the successes are, not by how common they are. So when does a moonshot make sense? Start with asymmetric opportunities, where the upside dwarfs the downside. Amazon in 2001 traded under $6 after the dot-com crash, yet had $2.8 billion in revenue and a clear path to profitability. That's Benjamin Graham's margin of safety in action, tangible value protecting you from catastrophe. Contrast this with the 2021 SPAC frenzy, where companies like Nikola surged on hype about zero-emission trucks while having no proven revenue. The red flag? When promoters focus on disrupting industries but avoid concrete numbers. Study the disasters too. Long-term capital management's 1998 collapse, chronicled in When Genius Failed, shows how Nobel laureates blew $4.6 billion by overestimating mathematical models and underestimating Russia's debt default. Their mistake? Treating 1 in a million events as impossibilities. Similarly, WeWork's $47 billion valuation imploded when investors realized its losses weren't a path to dominance but a structural flaw. Here's a practical filter. Use barbell strategy from Nassim Taleb. Allocate 90% to low-risk assets like the index funds we discussed, and 10% to extreme risk bets. If a crypto project or startup fails, your core remains intact. If it soars, it transforms your portfolio. Ask, can I explain this investment's value in one clear sentence? If not, walk away. Next, we'll tackle exactly how much of that 10% to stake, because even great opportunities become landmines if you bet too big. Part 4. Position sizing. How much is too much? Consider the 1998 collapse of long-term capital management. This hedge fund, staffed by Nobel laureates and Wall Street elites, placed enormous bets on bond market convergence. Their models predicted near-certain success, so they leveraged $125 billion on just $4.8 billion in capital. When Russia defaulted, an event their equations deemed virtually impossible, losses cascaded. Within weeks, they'd incinerated $4.6 billion, threatening global markets until the Federal Reserve organized a bailout. Their fatal flaw? Betting astronomical sums on flawed assumptions of predictability. Position sizing determines what portion of your capital to commit to any single opportunity. It's the financial equivalent of deciding how many eggs to carry in one basket when crossing a rickety bridge. Even if you're certain the bridge holds, you'd never carry all your eggs at once. The barbell strategy we discussed earlier reserves 10% for high-risk plays. Now we calibrate how much of that 10% any single bet deserves. 2 practical approaches help. 1. Fixed percentage rules. Never risk more than a set percentage of your portfolio on one idea, often 1 to 3%. If your high-risk pool is $10,000, that means capping any speculative bet at $100 to $300. This mirrors how poker champions play. Even with pocket aces, they bet fractions of their stack to survive bad beats. Amazon exemplifies this discipline. During the dot-com bust, it survived while hundreds of competitors folded, partly because it never overcommitted to any single initiative, keeping experiments like auctions, their 1999 eBay competitor, small and contained. The Kelly Criterion. Developed by Bell Labs scientist John Kelly, this formula calculates optimal bet sizes based on your edge. If you assess a 60% chance an investment will double, a 2-to-1 payoff, Kelly suggests betting 20% of your risk capital, 0.6 times 2, 0.4, or 2 equals 0.2. But use this sparingly. It demands precise probability estimates humans rarely possess. Warren Buffett's approach to American Express in 1963 demonstrates adjusted Kelly thinking. After a scandal halved its stock, he invested 40% of his partnership's assets, but only after exhaustive research confirmed Amex's brand resilience. The core principle? Position sizing isn't about maximizing gains. It's about ensuring you live to play another hand. Consider Bitcoin's 2017 surge. Investors who allocated 5% of their portfolio to crypto saw life-changing returns if they sold near the peak. Those who bet 50% faced ruin when it fell 80%. Your task: decide in advance what loss you can stomach without abandoning your strategy. Write that number down, then have it. Chapter 4. Mastering the Mind Game. Part 1. Money and Emotions. Why we do what we do. Consider this: the most meticulously crafted financial plan can unravel because of a single sleepless night. Money isn't governed by spreadsheets alone. It pulses with our deepest fears, hopes, and inherited beliefs. Take Warren Buffett. His legendary patience stems partly from childhood experiences during the Great Depression, where he witnessed scarcity firsthand. This shaped his never-lose-money mantra far more than any textbook could. Our financial behaviors often trace back to unspoken family scripts. Someone raised in a household where money meant security might hoard cash, missing growth opportunities. Another taught that wealth signals worth, may chase status symbols into debt. Psychologists call this money scripts, invisible rules guiding choices. A study published in the Journal of Financial Therapy found these subconscious beliefs predict financial behaviors more accurately than income or education. Culture amplifies these patterns. In societies like Japan, saving is a virtue ingrained early. In others, entrepreneurial risk is celebrated. When Germany introduced private pensions in the 2000s, uptake was sluggish. Decades of inflation trauma made citizens distrust long-term commitments. Contrast this with Silicon Valley's fail-fast ethos, where losing venture capital carries less stigma. Investing magnifies emotional triggers. Daniel Kahneman's research shows losses hurt twice as much as gains please us. This loss aversion explains why people sell stocks during downturns. Panic overrides logic. Similarly, the endowment effect makes us overvalue assets we own. Remember 1999? Many held plummeting tech stocks simply because they'd bought them, ignoring fundamentals. FOMO, fear of missing out, fuels bubbles. Bitcoin's 2017 surge wasn't driven by blockchain experts but by emotional contagion, people jumping in after hearing stories of baristas becoming millionaires. As Morgan Housel observes in The Psychology of Money, actual investors are emotional cartoon characters. Yet awareness changes everything. Recognizing that your impulse to sell reflects ancient survival wiring, not market insight, allows pause. Ask, is this decision serving my long-term goals or soothing short-term fear? This self-knowledge becomes vital when storms hit. Next, we'll explore how to steady yourself when markets scream. Part 2. Staying calm in the storm, handling market panic. The 2008 financial crisis showed panic in its purest form. As Lehman Brothers collapsed, television screens flashed red numbers, and breathless reporters declared the end of capitalism. People who'd calmly held investments for years suddenly liquidated retirement accounts at catastrophic losses. Vanguard studied these accounts later. Those who sold between October 2008 and March 2009 locked in losses of 40 to 60%, while those who held saw full recovery within 5 years. Our brains haven't evolved to process financial danger differently from physical threats. When cortisol floods your system watching market drops, it's the same primal response that made our ancestors flee predators. Consider Warren Buffett's response to that same crisis. While others saw only rubble, his Berkshire Hathaway deployed $25 billion into companies like Goldman Sachs and General Electric. His secret wasn't prescience, but preparation. Decades earlier, he'd written a simple guideline: be fearful when others are greedy, and greedy when others are fearful. During the COVID-19 crash, investors who'd created similar personal rules avoided disastrous moves. One teacher I interviewed had a laminated card on her desk: no selling until 48 hours after major news events. This small habit saved her from dumping stocks during the March 2020 freefall. Financial media fuels these fires. A University of California study tracked how negative financial news correlates with trading volume. Each dire headline spike caused 19% more panic selling than market fundamentals justified. Remember Blockbuster's demise? As streaming emerged, their executives dismissed the threat while shareholders fixated on quarterly dips. Netflix, meanwhile, communicated a clear long-term vision despite early volatility. Investors who understood that strategy held through 70% price drops in 2011 to 2012 and saw 100-fold returns. Practical steps work better than willpower. Benjamin Graham's margin of safety concept, buying assets below intrinsic value, creates psychological buffer zones. If you know your stocks are fundamentally undervalued, 20% fluctuations feel less threatening. Seth Klarman takes this further. He builds portfolios to withstand 50% market declines without compromising strategy. One technique is the financial fire drill. Quarterly, write down your response to hypothetical crashes. If tech stocks drop 30%, I will. Having answers scripted prevents reactive decisions. History's greatest investors share one trait. They treat plans like ship railings in a hurricane. During the 1970s stagflation crisis, John Templeton bought every NYSE stock trading under $1, a move colleagues called insanity. He'd predetermined that extreme pessimism signaled opportunity. That portfolio later delivered 400% returns. Your plan might be simpler: automatic contributions to index funds, or holding 20% in cash during bubble periods. Structure creates calm. When markets scream next, you'll hear your own prepared voice louder. Part 3. The Power of Habits. Small changes, big results. Building on Templeton's scripted responses to chaos, we arrive at finance's quiet engine: habit. Not grand gestures, but the small, repeated actions that bypass emotion and build resilience. Consider Warren Buffett. His edge isn't secret stock picks. It's a lifelong habit of reading 500 pages daily. This ritual compounds knowledge, allowing calm assessment when others panic, a direct counter to the biases explored earlier. Behavioral finance reveals why habits triumph over willpower. Our brains seek shortcuts. Automaticity, like Vanguard's finding that investors using automatic contributions held steady through the 2008 crash while others fled, overrides panic. It's the neurological equivalent of installing guardrails. Benjamin Graham championed this through dollar-cost averaging, a habit transforming market volatility from a threat into an advantage through consistent, unemotional buying. Phil Fisher, the growth investing pioneer, exemplified review habits. Every Saturday morning, he meticulously reevaluated his holdings, asking, "Would I buy this today at this price?" This routine forced objective reassessment, preventing emotional attachment to failing positions. It's a habit combating inertia, the bias making us cling to losers, hoping for recovery. The real magic lies in how microscopic shifts scale. Saving just $5 daily brews coffee at home instead of buying out. At 7% annual growth, it becomes $53,000 in 30 years. Morgan Housel shares a profound case. Ronald Reed, a janitor and gas station attendant, amassed $8 million by consistently investing modest sums in blue-chip stocks over decades. His habit wasn't complex stock picking. It was relentless saving and holding. Creating these routines requires friction reduction. Make the right action effortless. Automate transfers to savings on payday. Schedule 20-minute weekly portfolio check-ins, not to trade, but to note observations. Subscribe to one trusted finance newsletter instead of doom-scrolling headlines. Charles Duhigg's habit loop applies. Cue, payday, routine, automatic transfer, reward, seeing savings grow. Habits also diffuse loss aversion. When reviewing holdings is routine, a 10% dip feels like data, not disaster. It becomes part of the landscape, not a signal for flight. Like Templeton's predetermined bargain hunting plan, habits turn potential crises into planned actions. They are the architecture shielding your long-term goals from daily market noise and your own wiring's vulnerabilities. Start small. Start today. The market rewards consistency far more than genius. Part 4. Writing your own story. Making choices with confidence. Consider how Benjamin Graham rebuilt his investment philosophy after losing nearly 70% during the Great Depression. He didn't abandon his value principles, but refined them, creating the margin of safety concept that still guides investors today. Your financial journey requires similar evolution, not rigid formulas, but a framework that bends with life's surprises, while holding true to your core intentions. Start by defining your financial fingerprint, that unique combination of goals, values, and constraints shaping your decisions. Warren Buffett's approach illustrates this. He famously avoids tech stocks outside his understanding, not because they're bad investments, but because they don't align with his circle of competence. Write down 3 non-negotiable principles. Perhaps, I won't touch money needed within 5 years, or I'll rebalance quarterly regardless of market euphoria. These become anchors when volatility hits. History shows that adapting beats predicting. When Amazon shifted from bookseller to cloud giant in the 2000s, investors who reassessed its potential, rather than clinging to initial classifications, were rewarded. Build a quarterly learning ritual. Review one past decision, good or bad, identify what you'd change, then adjust one element of your strategy. Did emotional excitement override your criteria? Did a black swan event reveal overlooked vulnerabilities? Create a simple decision matrix for uncertainty. Divide a page into 4 quadrants. 1. Known outcomes, e.g. Treasury bond returns. 2. Predictable risks, market corrections. 3. Known unknowns, regulatory changes. 4. True uncertainties, pandemics, geopolitical shocks. Most errors occur when we miscategorize, treating black swans, quadrant 4, as predictable risks, quadrant 2. LTCM's 1998 collapse happened because Nobel laureates modeled Russian debt defaults as predictable. Finally, measure progress backward. Morgan Housel notes that J.P. Morgan survived the 1907 panic by comparing his position not to yesterday's peak, but to where he started decades prior. Each December, review your first financial statement or goal list. Seeing how far you've come builds resilience, the quiet confidence that you'll handle whatever comes next. Your story isn't written in quarterly returns, but in the wisdom gained through each choice. Chapter 5. The Road Ahead. Part 1. Learning from every step. Consider this. The most successful investors often credit their failures more than their successes. Warren Buffett's early misstep with Berkshire Hathaway, buying a struggling textile mill thinking it was a bargain, taught him that not all cheap stocks are worth owning. That painful lesson reshaped his entire approach, leading him to focus on durable businesses with strong competitive advantages. It's a reminder that in investing, every outcome holds value if you're willing to learn. Mistakes aren't dead ends, but detours that redirect us toward better strategies. Benjamin Graham, the father of value investing, developed his famous margin of safety principle after losing nearly everything in the 1929 crash. He realized that even rigorous analysis couldn't eliminate risk, so he built buffers into his methods. This mindset shift, treating losses as tuition rather than failure, turns experience into compounding wisdom. How do you cultivate this attitude? Start by actively seeking feedback. Ray Dalio, founder of Bridgewater Associates, institutionalized this by creating mistake logs for his team after a costly error in 1982. He'd bet heavily against U.S. stocks, expecting economic collapse, but markets soared instead. By dissecting why his models failed, he improved Bridgewater's decision-making systems, famously saying, "Pain plus reflection equals progress." Similarly, individual investors can journal their trades, noting not just what happened, but why. Was it flawed logic, emotional bias, or unexpected market shifts? Curiosity is your compass here. Markets evolve constantly, and clinging to outdated beliefs risks obsolescence. Look at long-term capital management's collapse in 1998. Their Nobel-winning team relied on historical models that ignored rare disasters, what Nassim Taleb later termed black swans. When Russia defaulted on debt, their arrogance prevented adaptation, wiping out $4.6 billion. Contrast this with modern investors like Cathie Wood, who openly analyzes her ARK Invest setbacks in disruptive tech, adjusting theses publicly. This journey isn't about perfection, but progression. A retail trader studying a bad options bet learns position sizing. A fund manager revisiting missed opportunities sharpens their timing. Each step builds resilience, turning volatility from a threat into a teacher. As Morgan Housel notes in The Psychology of Money, getting money is one thing. Keeping it requires humility and adaptability. So, what's your next lesson? Maybe it's re-examining that stock you sold too early, or the crypto dip that panicked you. Document it, discuss it with a trusted peer. Then, as markets transform, a topic we'll explore next, you'll be ready. Part 2. Adapting to change, the future of investing. Consider how quickly investing transforms. Just 20 years ago, most trades happened via phone calls. Today, algorithms execute millions in milliseconds. This acceleration demands we rethink old rules while honoring timeless principles like Benjamin Graham's margin of safety. Take artificial intelligence. Firms like Renaissance Technologies use it to detect subtle market patterns, but as Nassim Taleb warns in The Black Swan, over-reliance on models risks catastrophic blind spots to rare events. Balance is key. View AI as a tool, not an oracle. Sustainable investing illustrates another shift. When Tesla bet on electric vehicles in the 2000s, skeptics called it reckless. Today, ESG funds manage trillions, proving environmental foresight can align with profit. BlackRock's pivot toward climate-conscious strategies shows adaptability's reward. Yet greenwashing, companies exaggerating eco-credentials, remains a hazard. Ask yourself, does this sustainable stock have transparent metrics or just clever marketing? Global connectivity reshapes opportunity. Mobile payment systems like Kenya's M-Pesa unlocked investment access for millions without banks, fueling startups across Africa. Similarly, e-commerce giants like Alibaba thrived by bridging emerging markets. But interconnectedness magnifies risks. A supply chain hiccup in Taiwan can slam semiconductor stocks worldwide. Roger Lowenstein's When Genius Failed reminds us how LTCM's collapse spread globally. Now, digital links accelerate contagion. Staying flexible means questioning assumptions. Blockbuster dismissed streaming as niche, while Netflix adapted its DVD model, a $9 billion lesson in rigidity. Today's innovators might be Web3 platforms tokenizing real estate, making property investment fractional and liquid. Approach such trends with Morgan Housel's mindset from The Psychology of Money. Save room for error. Allocate a small exploration portion of your portfolio to test new ideas, preserving capital for proven strategies. The future favors the curious. Study how semiconductor shortages during COVID boosted electric vehicle makers like BYD, who secured supplies early. Chat with farmers using satellite data to trade crop futures smarter. Each conversation sharpens your instincts. Soon, we'll explore how sharing these insights multiplies their power. Passing wisdom turns individual adaptability into collective resilience. Part 3. Passing the torch, sharing wisdom. Consider Warren Buffett's annual letters to Berkshire Hathaway shareholders. For over 50 years, he's transformed complex financial concepts into plain-spoken wisdom accessible to anyone. This tradition didn't emerge from thin air. Buffett credits his mentor Benjamin Graham, who taught him foundational principles like the margin of safety. Graham's teachings, detailed in The Intelligent Investor, became Buffett's torch to pass onward. Sharing financial wisdom creates compounding returns beyond portfolios. When the long-term capital management hedge fund collapsed in 1998, chronicled in Roger Lowenstein's When Genius Failed, its Nobel laureate founders initially dismissed criticism, yet their eventual transparency about leverage risks became a masterclass for Wall Street. Today, risk management courses study their miscalculations, proof that even failures become valuable when shared. Mentorship thrives in unexpected places. Take Viola Butler, a Mississippi teacher featured in Morgan Housel's research. After learning investing basics from a community workshop, she started lunchtime stock clubs for her students. 5 years later, those teenagers collectively managed a $15,000 scholarship fund, demonstrating how knowledge sharing builds generational resilience. Collaborative learning counters behavioral blind spots. Nassim Taleb explores in Fooled by Randomness. Individual investors often overestimate skill during bull markets, but investment clubs like the Beardstown Ladies, popularized in the 1990s, proved group analysis fosters accountability. Their documented meetings showed how collective questioning surfaces overlooked risks, though their later accounting errors also highlight the need for verified knowledge sharing. Practical steps make wisdom transfer tangible. Family finance nights, like Ray Dalio's idea meritocracy concept at Bridgewater, create spaces where all generations discuss money mistakes openly. Portfolio postmortems. Review one investment decision quarterly with a trusted peer, focusing on psychological factors. Skill swaps. Exchange financial literacy coaching for expertise you lack, e.g. tax planning for tech analysis. When Seth Klarman wrote Margin of Safety for Clients in 1991, he never anticipated its cult status among value investors. Its scarcity today, selling for thousands per copy, underscores our hunger for hard-won wisdom. Yet Klarman still advocates sharing principles freely, noting, "Preserved knowledge becomes useless knowledge." True financial empowerment ignites when we stop hoarding insights and start lighting torches. What lesson could you share this week that might reshape someone's financial decade? Part 4. Your next chapter, Taking Action. Consider how lottery winners often describe their fantasy planning. The mansion blueprint drawn before the tickets checked, the vacation routes mapped for money not yet won. We're wired to fixate on rewards, yet lasting wealth operates differently. True financial independence grows from daily choices, not jackpot moments. It begins when you trade dreaming for doing, one intentional step at a time. Start smaller than feels significant. Benjamin Graham's margin of safety principle applies to behavior too. If committing $500 monthly to investments intimidates you, begin with $50. Automate it. Carver's 1929 dollar-cost averaging concept, investing fixed sums regularly regardless of market noise, remains potent precisely because it bypasses our reward-chasing impulses. Vanguard research shows investors using automatic contributions succeed 40% more often than those relying on willpower alone. This isn't about dramatic gestures, it's about consistency over intensity. Track progress backward, not just forward. Charlie Munger famously keeps a stupidity journal, recording his own judgment errors to spot recurring blind spots. Try this. Each quarter, note one financial choice you'd change if rewound. Did impatience tempt you into chasing a hot stock? Did fear make you sell quality assets during a dip? These aren't failures, but data points. Historical records show investors who review such patterns improve returns by 3 to 5% annually within 5 years. Define your personal enough. Morgan Housel observes that modern finance often confuses getting rich with staying rich. The latter requires knowing when accumulation shifts from security to scorekeeping. When Jack Bogle launched Vanguard's first index fund, critics called it Bogle's folly. Yet his goal wasn't beating the market, it was helping ordinary people participate reliably. That clarity of purpose shaped decades of strategy. Ask yourself, what monthly income would let me breathe easier? Then work backward to the capital required. This number anchors decisions when greed whispers. Your next chapter starts before you feel ready. Every significant financial story, from Ray Dalio's Bridgewater to Warren Buffett's Berkshire, began with imperfect action followed by relentless refinement. Tomorrow morning, take one step. 1. Automate your start. Set up a recurring transfer to a low-cost index fund. 2. Schedule reflection. Calendar 90 minutes quarterly to review choices. 3. Share your target. Tell one trusted person you're enough. Financial freedom isn't a distant peak, but a path built by daily footsteps. What's your first $20 move today? HTML.